Hey guys, it's Max. How's everyone doing today? Appreciate y'all for being here. Jackson, come here. Jackson, please come here, buddy. Stay over here, please. I forgot to put Jackson on his leash. That could have been that could be a mistake. Jackson, what are you doing? I think the neighbor's cat he may be trying to mess with the neighbor's cat. Jackson, get over here. Come here. Let me see you. Give me a kiss. And give me kisses. This puppy's so sweet. All right, guys. Sunday morning. I don't have anything scripted out, but I wanted to go over some SEC filings. I know that doesn't sound very exciting, but so what I do every once in a while is I go through the title, all of title, and that's Defiance's and YieldMax's ETF sponsor. And they also have they also sponsor some other interesting funds too, SoFi, and they sponsor a bunch of them. Every once in a while, I go through the reports and I see if they filed for any new funds, and if it's something interesting, I tell you guys about it. Well, there's a lot of them out today, but none of them are interesting enough on their own, I don't think, to rise to the level of its own video. So I just thought we would review some of the most recent filings. So let's just kind of go through here. Okay, this one's interesting. The ticker is JOJO. And I used to know what that stood for. I think maybe there's one called RORO that's a sister fund, and it stands for risk on, risk off. I think this one stands for junk on, maybe junk off. In any event, these here's RORO, risk on, risk off. Well, they both done pretty poorly. You look, they're both way underperforming on the year. This one rotates. This one's this JoJo. Let's see what it says. Greater exposure to the U.S. high-yield corporate bonds added to the performance of the fund during the reporting period, while exposure to the 20-year, the TLT, detracted from the performance. So this is just a just a fixed income fund. I really didn't think it's that interesting. I was kind of interested in RORO. RORO could kind of be considered trend following, or let me think of a way to describe this. Risk on, risk off follows an index out there somewhere that it looks at some ratio to determine if we're risk on or risk off in the market. And then if we're risk on, it invests in stocks. If we're risk off, it switches to bonds. That to me is kind of interesting. So here it is, fund summary. RORO rotates offensively or defensively based on historically proven leading indicators of volatility with the goal of taking less risk at the right time. The ETF rotates around U.S. small caps and growth. That's risk on. So I guess they probably buy the Russell when it's risk on, and then they switch to treasuries when it's risk off. Here's the interesting thing to me. You know how I love my metrics. They do this based on a lumber to gold ratio. You know how I'm always looking at VIX and VIVIX and using it to time decisions on the SPY, or to try to, anyway, they're doing the same thing, except they're trying to time decisions on the Russell, on going back and forth between being all in Russell or all in treasuries, risk on or risk off, based on if lumber's blowing up relative to gold. That means it's risk on, I believe. Yeah, of course. And if gold's blowing up relative to lumber, that means that the economy's crashing, because lumber is a precursor for people that want to I mean, you need it to build houses and stuff. People look at lumber as a sign of, economic economic prosperity. So when lumber futures are crashing and gold's blowing up, it means people think the end of the world's around the corner. When the opposite's happening, people are building, everything's going, inflation's low. There's not a lot of demand for stuff like gold. Anyway, this one is interesting to me. Now, just the theory of it is, I don't know. It's really small, 5.2 million. And it's had a less than inspiring performance, but I like the idea of it. But I like the idea of it. So what does it do here? It pays a 62-cent dividend. All right, top 10 holdings, SCHGs, their number one holding. Vanguard, small cap. So they're obviously risk on right now. Of course, you better be risk on right now. They have the Russell. I told you it was the Russell, and then they have a small amount of cash equivalents. Anyway, okay, so that's interesting. Well, this is just their annual report. So, that's the only reason I would have thought to, they were going to talk about it. I'm not going to probably make a review on that video, and I'm certainly not going to review this ETF. So this one is called, I don't know how you say that first name, Adesina Social Justice All Cap Global ETF. Okay, now this one's is still in third place compared to its benchmarks, but it's not doing as bad as the other ones. It's up 16% year to date. Now I don't know how they determine social justice. They have Aflac. The top 10 holdings are Aflac, Merck. Merck is big pharma. Visa, big banking. Juniper Networks, ADP. The Progressive Corp, Snap-on, S&P Global. In any event, I don't know how they determine social justice. I'm not that interested in that one. It's funny, though. This one right here is something I'm more interested in, but all my lefty communist friends would probably like this freaking social justice one, right? I mean, but this is me right here. God bless America. The ticker's y'all. And look at that. And it's freaking beating its benchmark, 36% year to date. Now this is a fund. This is something I could get behind. Who cares about social justice, right? I'm just joking. I'm just joking. I know I'm just joking. All right. I think we can have social justice and prosperity at the same time. Okay. All right. So NVIDIA. Top 10 holdings. We have NVIDIA, Tesla, HCA, the hospital company. So Boeing, Broadcom, Amgen, Allstate, Costco, Charter, Danaher. Now that's a blue chip fund right there. And of course it's up 36% year to date. So, people don't talk about that one that much. I know I have some good patriots to watch my station. I can't believe I don't have anyone in that one, or that I know of. Anyway, go get y'all some y'all. It would have been a great time to have y'all about a month ago. We should be long y'all and short social justice. That's the pairs trade of the next 4 years. Okay. SoFi. This one's another one I haven't heard of. I've heard of SoFi's fund, THTA, of course. I guess I have heard of this. It's just SFYX. I guess this is their version of the S&P 500, of the SPY. I don't know much about this fund. Biggest asset, top 10 holdings, NVIDIA, Tesla, Planeteer, Microsoft. What's not to like? This is, it's just S&P 500, it looks like. Okay, so that's interesting. That ticker was SFYX. All right, so this one's interesting. It's called the Leatherback Long Short Alternative Yield ETF. The ticker is LBAY. The cumulative performance has been good, about 12% since inception, while the S&P's got about 14 over the same time period. top 10 holdings. Exxon, Newmont, 3M, Fidelity, Zimmer Biomet Holdings, Altera, Altria, Lamb Weston. Now this is an interesting. This one is less blue chippy than the other one, and of course, a long short fund typically has half their stocks or half their portfolio, or maybe not half, but some portion of their portfolio is long. But then they'll also have a short book, where they will also own short stocks. Now, right here, this is the top 10 holdings. I like to see the top 10 shorts. But I really don't want to look into it that far. We could look into it. If you're interested in it, check it out. Or if you guys are more interested in any of these specifically, let me know and I'll do a review. My reviews aren't that good anyway. If you're interested in any of these, let Retire on Dividends know, or one of the guys that does a good review. All right. So I think there's one other one I wanted to show you guys, not that. Yeah. So this one is one I've totally never heard of. It's called Unlimited Hedge Fund Multi-Strategy Return Tracker. The ticker's hedge fund, HFND. Never heard of this. It's underperforming. Hedge fund strategies often do underperform or almost always underperform the SPY. Hedge funds have different goals than growth funds. That's something I never did understand until just recently. I didn't understand why hedge funds lots of times had shitty returns, because a hedge fund lots of times a rich guy's trying to use it to balance the volatility out of his portfolio, or to hedge. They might have the hedge fund on expecting it not to do well, or not to do that well, because they also have 40,000 shares of Apple, and you know what I'm saying? Those kind of guys. So these kinds of funds can make sense for those kind of guys. But lots of times when you look at these hedge fund strategies, they underperform, but they have less volatility. That's kind of the characteristic of hedge fund strategies. So anyway, so let's see. The fund intends to hold positions that track the risk return profile of the hedge fund industry. There's a hedge fund index out there that looks at and that's what I'm talking about. That index outperforms. Here's maybe it's right here. Multi-strategy return tracker. Well, I mean, just look, even on their own, even in their own literature, this strategy's made 6%, while the S&P's made 28%. Yeah. So these are sophisticated strategies for wealthier investors, because interesting. All right, so I also wanted to go over one other thing. I saw this today. Well, not that. Not that. I am going to turn on, I'm doing something on that too, but that's not it. I made a week-long chart of Alti. Here's an Altiverse for a week. These are all the stocks that Jay has, that has been in the Alti universe just in 1 week. Now this was the change. This isn't the change for the week. I should have done that. This is the change on Friday of all the stocks. Now, granted, some of these weren't in here on Friday, but anyway, I guess I need to go back and make it the change for the week, and make this the change for the week. But anyway, it's the change for Friday. So you can see Alti was down 82 bips. Where on the week, they didn't do a bad job picking stocks. I mean, on the week, if they would have just bought shares of each of the stocks they picked, it was pretty much dead even. Okay, I had a Yahoo Finance thing. Where was it? Maybe it's behind this tab. Where was it? Yep, there it is. Let's check this out too. The stock market is doing something witnessed only 3 times in 153 years. And history is clear what happens next. In case you haven't noticed, the bulls are firmly in charge of Wall Street. Since 2024, the Dow Jones Industrial and the NASDAQ have gained 17, 26, 17, 26, and 28%. I guess S&P and NASDAQ. So S&P's up 26, NASDAQ's up 28. And they say a number of factors are contributing. So the stock market's only done this 3 times since January 1871. All right. So throughout the year, there have been an assortment of correlative events, forecasting tools, and data points that have warned of potential weakness in the U.S. economy or stock market. This includes the first notable decline in the U.S. M2 money supply since the Great Depression, the longest yield curve inversion in history, and the correlative performance of equities when the Federal Reserve shifts to a rate easing cycle. However, one historically flawless valuation metric stands heads and shoulders above all these other tools and do something right now has only been observed 3 times in 150 years. Most investors are probably familiar with the price-earnings ratio, which divides the company's share price into the trailing 12-month earnings per share. The PE ratio provides a relative quick way to compare a company's valuation to its peers or the broader market. All right. However, this has limitations, blah, blah, blah. A considerably more encompassing valuation tool and the metric currently making history is the S&P 500 Shiller's PE ratio, also referred to as the cyclically adjusted PE ratio or CAPE ratio. Shiller PE accounts for average inflation adjusted earnings per share from the previous 10 years, which smooths out the impact of shock events and allows for an apples to apples valuations looking back over 150 years. Okay, so right now we've only been this high 3 other times in history. One time was the .com early in my trading career, in the .com bust from 99 and into 2000. Another time was it looks like another time was we'll just read the article. As of the closing bell, November 13th, the CAPE ratio is 38 points, double its average reading. More importantly, it's reached its reading only 3 times. December 99, during the .com, it peaked at 44. During the first week of 2022, it very briefly lifted above 20. And I'm telling you what, the first week of 2022 would have been a great time to get short, right? So it was definitely right that time. I mean, the problem with these things, though, in the first week of 2022, when it was overbought, it had been overbought probably the 6 months prior to that. I mean, so when is it overbought enough that it's going to turn it? I mean, this thing tells you it's the timing's up to you to figure out. This thing tells you the valuation, but you have to figure out the timing yourself. Okay. So what's noteworthy is what's happened to Wall Street's major stock indexes following these prior periods when valuations became very clearly overextended to the upside. The .com bubble resulted in a peak to trough drop of half, 49% in the S&P 500, and a considerably steeper decline in the NASDAQ composite. Meanwhile, the Dow Jones, S&P 500, and NASDAQ entered respective bear markets in 2022, and they did. And they pulled back, 30%, 20? I mean, from top to bottom, and they closed the year down 20% or something. 2022 was a bust. Stepping back even further, there have only been 6 instances since 1871 when the Shiller PE surpassed 30, including the present. Following each of these 5 prior occurrences, the Dow, the S&P 500, and NASDAQ eventually, that's the key, eventually fell between 20 and 89%. Oh my gosh, that's a nightmare. Although the Shiller PE tells us nothing about when the stock market correction bear markets might occur, thus far it has a flawless track record of foreshadowing major moves lower in the stock market. Well, that's not why I was not as bullish on next year as I am on last year. My theory on next year is, well, we're up 20% this year and we're up 30% last year. You know, I just don't see. I mean, it'd be a great time for freaking. It'd be a great year to slip in a pullback. Maybe the hard landing will. Maybe when the inflation from Trump's policies kick in and the honeymoon wears off, it'll send us into a. It'll send us in. We'll finally get the hard landing we've been dodging the whole time. I mean, that's one scenario. Anyway, who knows? And we could also just keep going straight up another year. I mean, the trend's your friend until the end, right? Well, the good thing is, though, seriously, so we follow shorter term trend following signals every day on my channel. When the market sells off, usually, and you guys have seen it, it usually gives us a day or two's notice, not always. But so a person that's worried about this happening, somebody like me, as long as the market keeps going up and the trend signals are positive, you nothing to worry about. But whenever you get a bearish signal, this next year out of your trend following systems or whatever, however you guys like to look at it, maybe pay more attention to it. Maybe, this past year, whenever you get signals, sell signals, like in August was a prime example. You get a quick 5 or 10% pull, sell off, and then it blows right back up. Then it recovers within a month. That's kind of been the trend. All I'm saying is maybe that won't be the trend in this next year. Maybe we'll get a little bit more an actual sell off with a little bit of follow through where we pull back 20, 25, 30% instead of just 5 or 10 real quick and then blow right back up. That, as you guys know, that's kind of been the pattern the past couple of years. We had a real quick pullback in October of 23. It was vicious though. And we had a really quick one in April of 24, and then August of 24 was the worst and most serious of the three. But I wouldn't be surprised in the next year if we have one that makes August look like child's play. That's all I'm saying. I'm not trying to give bad news on a Sunday morning. Just thought it'd be fun to catch up and see what's going on with you guys. And I thought you guys might be interested in some of these funds. So to review, we got JOJO. I think that means junk on, junk off. I think they rotate from junk bonds to maybe non-junk bonds. Yeah, that's probably what it is. They probably rotate from credit quality rotation. That's exactly what it is. All right, so then we have RORO, risk on, risk off. They rotate back and forth between Russell and what was it? Russell and government. Russell and why can't I think of what they rotate back and forth? They rotate back and forth between Russell and T-bills, cash basically. Risk on, risk off. Risk off would be governments, T-bills, whatever. All right, so then we also looked at the God Bless America ETF. That one's called YAL. That one's been performing well. I wonder how they determine their stock picking. What makes a company, good? I mean, Tesla, I could see, but what makes NVIDIA? What makes HCA? I mean, HCA is owned out of Tennessee, I think. I mean, it started in Tennessee, maybe by Republicans. HCA is a Republican healthcare, or it was when it started. There's a senator from Tennessee whose family owned that, I believe. Boeing, Broadcom, Amgen. Well, anyway, it'd be interesting to see what their criteria is, but we don't have time to get in that today. So then what do we have? Then we have the SoFi SFYX, which looks like it's S&P 500 alternative. Then we also had this Leatherback long short alternative, which is more like a hedge fund type thing strategy. So it's going to underperform but have less volatility. And sure enough, that's kind of what it does, LBAY. Then we have God Bless America. We've already seen that one. And then we have this one, HFND. Don't really know that much about it. It's some kind of hedge fund strategy. Maybe I'll look into it and do a full review on it someday. It looks like it mainly holds. It holds some growth and some bonds. So, all right, and those, and then there was a social justice one in there somewhere that I didn't mean to leave out, but I think I shut it out. Anyway, the parish trade for 2025 is long y'all and short social justice. All right, we're gonna do retirement parish trade and see how it works out. Long this one, short the social justice one. I really don't remember what that one was even called. It had some name I had a hard time pronouncing. All right, guys. Well, I just want to catch up because it's Sunday and I was bored. I appreciate you guys for being here. Have a good day.